Welcome to Stock Talk, everyone. Today, we're jumping straight into Visa's latest numbers, specifically their fiscal second quarter 2025 results. The official report just dropped on April 29th. So our plan here is to really cut through the noise. We want to pinpoint the key takeaways from that report, look at their revenue, profitability, what they're signaling about the future, and maybe what it all means for the bigger financial picture.
Sounds good. Let's start right at the top with the headline performance figures. Okay, so Visa reported net revenue growth of 9% year over year. Pretty solid, but interestingly, if you look at it on a constant dollar basis, basically stripping out currency effects, that growth was actually stronger at 11%.
11% constant dollar. Okay, that does paint a slightly stronger picture of the underlying business. But then the GAAP net income, that actually went down 2%, right, to $4.6 billion.
That's right, yeah, slight dip on the GAAP side. However, and this is important, their non-GAAP net income was up. It increased 6% to $5.4 billion. And non-GAAP earnings per share, or EPS, that jumped 10% to $2.76.
Okay, so revenue up nicely, GAAP income down slightly, but non-GAAP income and EPS both up. What's the main reason for that gap between the GAAP and non-GAAP results?
Well, the big driver this quarter was a hefty litigation provision. We're talking $992 million. GAAP, that's generally accepted accounting principles, requires companies to include provisions like that for expected future costs in their current earnings. Non-GAAP measures, on the other hand, often adjust for these kinds of less predictable or maybe one-off items. The idea is to give investors a clearer view of the core ongoing business performance.
Got it. So that litigation provision really skewed the GAAP number downwards. All right, let's look at what's actually driving the growth then. Payments volume.
Yeah. Payments volume saw an 8% increase. And again, that's on a constant dollar basis. It suggests consumer spending is, it's holding up pretty well, resilient.
And cross-border. I imagine that's a key area too.
Absolutely. Cross-border volume growth was even stronger. It jumped 13% constant dollar. That's a significant number. It really points towards the ongoing recovery in international travel and maybe e-commerce too. People moving around more, spending across borders. And that 13% holds even if you exclude intra-Europe transactions, which is a big chunk itself.
Right. 13% is quite robust. And what about just the sheer number of transactions?
Also up. Processed transactions increased by 9%. That brings the total to $60.7 billion.
$60.7 billion. Wow.
Yeah, it really highlights that ongoing shift, doesn't it? More and more payments moving to digital channels.
Definitely. Okay, so let's maybe break down the revenue streams a bit. Where's the money coming from?
Sure. So service revenue, that came in at $4.4 billion. That's up 9%. Data processing revenue was $4.7 billion, up 10%. International transaction revenue, that also grew 10%, hitting $3.3 billion. And then there's the other revenue category. That one saw a really big jump, 24%, reaching $937 million.
Interesting. Lots of growth there. But the report also lists something called client incentives. $3.7 billion, up 15%. And it notes this is a contra revenue item. Can you unpack that for us? What does that increase imply?
Right. So client incentives are basically deals like rebates or discounts that Visa gives to banks and other partners to encourage them to issue Visa cards and route transactions over their network. It's called contra revenue because it directly reduces the gross revenue they report. So you take the gross revenue, subtract these incentives, and you get the net revenue figure we discussed earlier. Seeing a 15% increase there, well, it could mean a few things. Maybe the market's getting more competitive, so they need to offer better deals. Or it could be a strategic move to lock in key partnerships or drive even higher volumes long term. It's essentially a cost of doing business to maintain or grow market share.
Okay, that makes sense. It's an investment in a way. Let's shift gears slightly to the balance sheet. They've got $15.2 billion in cash and investments, but also $20.8 billion in total debt. How does that position look to you?
Well, the cash position is pretty strong. $15.2 billion gives them a lot of flexibility. The debt level, $20.8 billion, is, substantial, but you have to look at their ability to service it. And their cash generation is impressive. Operating cash flow for the first 6 months of their fiscal year was $10.1 billion. That's actually up 24% compared to the same period last year. So they're generating plenty of cash to cover debt payments and invest.
And speaking of investing, capital expenditures were up too.
Yeah, CapEx was $672 million over those 6 months, up 23%. So they are putting money back into the business, technology, infrastructure, things like that.
And they're certainly returning cash to shareholders as well. The report mentions $5.6 billion just in Q2.
That's right, a significant return. It breaks down into $4.5 billion used for share repurchases. They bought back about 13 million shares at an average price around $340. And the rest, $1.2 billion, was paid out as dividends. That's 0.59 centers per share.
And on top of that, they authorized a new share repurchase program.
Yes, a big one. $30 billion, authorized as a multi-year program. It definitely signals confidence from management about the company's future prospects and a continued commitment to returning capital.
There was also a mention of a $375 million deposit into a litigation escrow account. The report says this has a similar economic effect on EPS as share repurchases. How does that work?
Okay, so think about it this way. Uncertainty about future litigation costs can be a drag on a stock's perception. By putting money aside specifically into an escrow account for these potential costs, Visa is essentially reducing that uncertainty for investors. From an earnings per share perspective, using cash for this purpose means that cash isn't available for, say, dividends or other investments right now, similar to how using cash for buybacks takes it off the balance sheet. While it doesn't directly reduce the share count like a buyback, proactively managing and funding that liability can be seen positively by the market, kind of like how reducing share count boosts EPS. It removes an overhang.
Ah, I see. It's about managing risk and perception, which indirectly supports the value, similar to a buyback boosting EPS mechanically. Okay, going back to the non-GAAP adjustments, we talked about the big litigation provision. What else are they typically adjusting for to get from GAAP to non-GAAP?
Good question. Besides that $992 million litigation item, this quarter they also excluded, $23 million in net losses from some equity investments. They consider those outside the core business operations. Then there was $64 million related to the amortization of acquired intangible assets. That's often a non-cash charge from past acquisitions. And finally, $32 million in acquisition-related costs, like integration expenses. So mostly things tied to M&A or things deemed non-operational.
Right, and this adjustment process, along with looking at constant dollar figures, is really about trying to see the underlying operational trend. Yeah.
Exactly. It helps filter out the noise, like we mentioned earlier. The reported non-GAAP EPS growth was 10%, but strip out the currency impact, and the constant dollar non-GAAP EPS growth was closer to 11%. It just gives you that cleaner view of how the actual business performed in its markets, regardless of, say, a strong or weak dollar.
Okay, so looking forward now, what did Visa flag in the report as key opportunities?
Well, they highlighted several things. The big one is still the ongoing global shift from cash to digital payments. That's a long-term tailwind. Also, the continued growth potential in cross-border transactions, both travel and e-commerce. They're also focused on expanding their value-added services, things like analytics, security tools, consulting that go beyond just processing the payment, plus growth in commercial payments, B2B, pursuing more strategic acquisitions, and developing new payment flows, like new ways to move money.
So lots of avenues for potential growth. What about the other side of the coin, the risks they mentioned?
The risks are pretty consistent with what you'd expect in this industry. That ongoing litigation around interchange fees is still a major one. It's complex and has been around for a while. Regulatory pressures are always a factor, varying by region. Macroeconomic uncertainty is on the list too. If economies slow down, consumer spending could weaken. And then you have currency fluctuations, which we saw impact the numbers, increasing competition from fintechs and other networks, and of course the constant threat of cybersecurity issues.
Makes sense. A complex landscape. So finally, how did the report sort of summarize Visa's position and focus now?
They highlighted their strengths. Clearly, the strong revenue growth we discussed, especially the robust cross-border performance, also the steady increase in processed transactions, the significant shareholder returns, and that new big buyback authorization.
And their focus areas going forward?
Key priorities include, naturally, managing that litigation risk effectively, balancing the need to invest in growth against maintaining cost discipline, trying to mitigate the impact of those currency swings, and fundamentally just staying competitive in a really dynamic payments market and navigating different economic conditions around the world.
Okay, so to quickly wrap up our deep dive on Visa's Q2 2025 results, we saw strong top-line growth, really driven by those core business drivers like payments volume and cross-border recovery. GAAP earnings took a hit from that large litigation provision, but the underlying business, looking at non-GAAP and constant currency numbers, seems quite healthy. And the company's clearly focused on returning capital to shareholders while still investing for growth, but they're also mindful of the risks out there.
Which really brings us to the final thought for you, our listeners. When you look at all this, the strong growth, the litigation impact, the focus on shareholder returns, the opportunities, the risks, What do you think are the most crucial factors that will really shape Visa's performance over the next few quarters? And perhaps more broadly, what does this tell us about where the whole payment processing industry is headed? What are the key things you'll be watching?